already said. Okay, welcome everybody to Wall Street Reporter's next Super Stock live stream, October 28th. We are back with Organic Garage, OGGFF over the counter, OG on the TSX. Matt, welcome back.
Jack, good to be here. Always good to sit down and talk with you.
Fantastic, Matt. Actually, I want to get lower the camera a little bit, so we're at eye level. I just realized we're a little bit off. Before, okay, perfect. Okay, this is as close as we're gonna get right now. So, great. You have some really impressive news in the market today. Surprisingly, the market hasn't reacted to this, which I think is, I would say this is like a key inflection point. You've announced that essentially you're going to be expanding. You're ready to scale right now with more stores. Potentially this could be. We talked before. This is what you have as a global brand. So, this is really like the beginning here. So before we get into that, like for anybody that brand new tuning into our program for the first time, our goal with the Wall Street Reporter's next Super Stock live stream is to bring you those stocks which have that 10x to 100x upside potential. Companies going after massive multi-billion-dollar market opportunities that are at a key inflection point and have multiple catalysts in place to ignite that increase in shareholder value. We've already had 9 stocks that are up between 10x and 50x in the last 18, 20 months. I think Organic Garage has all the key ingredients, Matt, no pun intended, key ingredients, to be that next 10-bagger plus. So we're going to go into some quick, get a quick update. And everybody watching, please ask your questions in the live chat because the questions really is what makes these events special. And decide for yourself if you think Organic Garage is going to be that next 10x to 100x winner. So Matt, with that out of the way, you put out an announcement today that you've engaged, what is it, Savills, which is, the major, commercial real estate firm that, people, tenants use, for big deals. So walk us through that. You're hiring them to start scaling out locations, starting with Toronto, the greater Toronto area as a starter.
Yeah. So just building on what you discussed. So we've engaged Savills. They're a world-renowned real estate company. They handle billion-dollar brands in terms of finding real estate, commercial real estate, and we've had a direct and indirect relationship with them, since we've been a publicly traded company. But engage them to formally go out to the market and to start soliciting, potential sites. Since COVID happened, we've been contacted by numerous landlords and different varying discussions.
Yeah, it's a buyer's market for you, right?
Absolutely.
This is the perfect time to be expanding.
Yeah, so we were always in varying conversations, but we realized we need to take a much more focused and direct approach to take advantage of the opportunities in the market. So we engaged with them. We sat down. We plotted out the Toronto and Greater Toronto area to take a hard look at where we want to grow, how many locations can the area support, and today's press release shows, the geographic map that easily shows just in the Ontario market 20 to 30 locations, and we're not even fully filled out in Ontario. There's areas that we haven't even touched yet. So the potential in Ontario, we've always said, as Canada's most populous province, has a ton of potential for us to become like a national leader in the organic and all natural grocery business. And then once again, as we build the brand, the opportunities that exist, potentially outside of our domestic market, like we touched on our previous interviews, the brand is there, and now's the time to take advantage of kind of how the market has continued to evolve and capitalize on the opportunity that's presented to us.
Okay. I think it's very important for investors to understand really, like, okay, any major retail brand, whether it's like, Walmart, Home Depot, Whole Foods, you name it, they all start off first with targeted, in a targeted area, that you build out the stores, you kind of get, you kind of show the market that you could scale, and then you can really, now you already have 4 stores, you're generating what, 25 million plus.
Yeah.
I think 30 million, 20. I mean, the numbers are there. And now what you're saying is so. And now you're saying that basically Savills. I mean, now these guys, they do like really serious research, demographics, everything,
Yeah.
and they've come up with. They're saying that you potentially can open the market can support 20 to 30 organic garage stores.
Yeah, just in our home market. And you
In
are right. I
Toronto,
mean,
yeah.
we analyze the market. We look at things like population density in the towns and cities we evaluate. We look at average household income. We look at education level. We look at ethnicity. Those are kind of our 3 or 4 key criteria. And then we map it out. And our goal was to create in the Toronto and Greater Toronto area. I would say actually in our map it shows 4 territories, but I would say it's actually technically 5 because Toronto itself, being the downtown area, counts as its own territory. And our goal is to have between 5 and 6 stores in each territory that are supported by specialists. And so when you see on the map, we chart out a 45-minute drive time between locations, which makes it easy to support logistically, from a management support level to supervise, those 5 or 6 locations in each territory. And so when we mapped it out, it became very apparent to us, the potential for the market, given the size stores that we're looking for. And like we discussed in our previous interview, the beauty about the real estate model that we have is I like to say, we're too big for the small guys and we're too small for the big guys. And so we've hit a real sweet spot in this 10,500 square feet where, Jack, you touched on it. We could be beneath a condo building. We can be in a suburban strip mall, but we're not competing with the big boys for real estate and taking, D, E, and F sites, because we gotta, in terms of the pecking order, and we're too big for the small guys. So we're able to take advantage of sites that they couldn't take advantage of. And then, coming out of COVID, unfortunately for some, but fortunate for us, some businesses have closed. And, whether it's like I mentioned it before, like a buffet restaurant, it could be a general merchandise store. It could be a clothing store.
There is a ton of real estate. I mean, forget about. I don't. I mean, I don't know about Toronto. 'Cause I haven't been in Toronto in years, but like in the U.S., anywhere you look, that size space there's a ton of it out there. I mean, like if you walk in like I don't know, you in Manhattan, there's like half. You have. They would pay you. They'd probably pay you like to take one of those spaces because again, one of the things that landlords love about what you do is you're really a value add tenant. I mean, it adds value to the building, to the property, the surrounding area. It's really, it's like, it's a wonderful thing. So these guys are saying you can open up, the market has, it could take on at least 20 organic garage stores. And by the way, that's in addition to other supermarkets, whatever is out there, right? So they're saying the market can, okay. That means, so for Toronto, those 20 stores, which would get you to a total of, I guess, 25. So that would get you to, what are the numbers? How much does each store generate? Walk us through
Our
the
goal
numbers
is
again.
always between 6 and 8 million a store. That's our kind of sweet spot. So, you're talking 125 to 150 million in sales, and we're a big player. That is a lot of stores and a good sized company that is very, very attractive. And like I said, that's conservative. We outlined the towns and cities in our press release based on the mapping we did, but some of those towns and cities, like we listed Toronto as one. Well, Toronto proper could fit 4 to 6 stores. A town and city like Mississauga, which is our second most kind of populous town and city in Ontario, can fit at least 2. So some of those are multiples as well. So all we've just basically done is put, I like to say, it's kind of jokingly like the bat signal up to landlords, real estate agents, and developers, and saying like, look, we're out there. We are now formally looking. Where informally we were definitely in the market before, but we are now saying, hey, look, and Jack, I think you hit the nail on the head. We know our model. We know what goes into a store. We have jokingly the binders, the spreadsheets, the graphs, and everything that we need.
Yeah, the system is in place. Yeah, the systems
controls,
are in place. Everything. And you're like here's the thing. So landlords, not only do they love the concept of what you're doing, but also, you have a proven track record. They know that these stores, you're not going out of business. When these stores open up, they're going to be there for decades. I mean, this is
Oh
the
yeah.
type of thing that is.
Well, grocery stores are anchors. They're anchors to communities. They're anchors to developments. We're long-term tenants. And when you're looking from an attractiveness from a developer, standpoint, grocery stores are tremendous traffic drivers for their plazas. So incrementally, when you look at the other things that might be in their development, a QSR restaurant, hair salons, places like that, all that they can get premium rents on because there's a huge amount of traffic being driven to their sites with a grocery store. And the type of clientele that we're driving to their sites are premium clientele. So even though we're a value operator, we are driving I call A tier customers into
It's not like
developments.
you're not like a vape shop or a tattoo
No,
parlor basically. So it's
no.
it's a value added tenant.
Well,
And
when you're looking for accessory tenants, you're potentially, as a landlord, you're able to get a different style of accessory tenant than you would with potential other, anchors. So it's a trickle down effect. And that's why, I touched on it before in terms of our financial model. And people always say, well, how do you get the landlord to give you money? Well, we get the landlord to give us money because we're a long-term tenant, we're a grocery store, which is a huge traffic driver, and we're able to drive incremental profitability on the other tenants they potentially have in the development. And in today's day and age, coming out of COVID, grocery stores were proven as pandemic proof. They were the only businesses that stayed open pretty much 100% of the time because people need to eat. And so, if you're looking for something that's stable and long-term in your development, you can't get better than a grocery store. And so we are in demand.
Especially with your brand, the whole organic, the whole thing is just it's a really incredible thing. And again, again, landlords they're very sensitive to what do they call it? Amazon proof. This is Amazon proof. You help the whole surrounding. So it's a fantastic thing. So the big question now is So with these 20 stores, you could be doing 160 million annually in sales, right? And these are all big margins in this business. The question is, how fast can you get to these 20 stores, and then go from there? How fast can you open up these 20 stores, Matt?
Yeah. Well, look, store development is predicated on available real estate, and I think today's press release. I wouldn't say it's the start of the snowball turning because we've already started it, during COVID on our own in terms of our own conversations with prospective new sites. But this accelerates things. An announcement like this will be picked up in trade magazines, not only in our own industry, but in the real estate community. And then, depending on how fast sites are available is how fast we can scale the business. But going back to my point and my quote in the press release, and it's a valid concern from any potential existing shareholder or new shareholder is look, we're going to be smart about it. We're not in the business of over diluting the company. We want to be smart and sustainable with our growth. It takes 6 months to build out a store. So for us, it's filling out our calendar of development and making sure it meets, kind of the financial resources we have on hand so we can do it in a sustainable way. But look, I said it before on this program, we are a growth story. There is nowhere but up for organic garage bricks and mortar, and we'll touch on it soon in terms of our other business, the Future of Cheese. But we are at the beginning of our growth cycle, and the growth trajectory and the runway for growth is huge. And so today's press release just proves that potential. And our goal now is with Savills is to start to fill out that calendar in terms of new store development and reach the potential that the brand has in our domestic market here.
Okay. And by the way, I'm gonna dive into that. The brand's Future of Cheese, Kitchen
Originals.
Because of that show, I always that thing with the kitchen cafe. Okay. So what happens is we're gonna talk about there's tremendous synergies when you have these powerful brands. You kind of have this flywheel effect driving the growth when you have many stores. You're selling your own brands. We'll get into that in a second. But okay, so essentially, you're saying you can grow as fast as locations become available. So in theory, let's say in theory, Savills comes to you and says, "Hey, Matt, listen, we got 50 calls that came in, inbound calls this weekend that came in from landlords, phenomenal locations. They're willing to give you, I don't know, a year free rent, tenant, whatever, the whole thing, right? How fast can you open? Let's call it 4 stores. And because you don't have to do 6 months, then do another. I mean, you could do several stores at once, right? You could do
Oh
two
yeah,
at once,
the
three at
stores
once.
to build out are relative, they're very simple. So going back to, the systems we have in place and what we've learned from the two stores that we opened since we've been public in terms of trialing things there, we know exactly the inputs that need to go into a store. So physically building the stores is not an issue. And you are right, Jack. I mean, we have the construction team in terms of the contractors and tradespeople we deal with that can build multiple sites at once across in our domestic market. And look, these are national construction agencies that can build out of province as well. So, we've teamed up with the right people. They know our finishing. They know our expectations in terms of store execution. We know our branding style. So yes, absolutely, we can build multiple stores at once. And it's, the job of Savills is to understanding our financial criteria, and what we're asking for is evaluate all those 50, 100 inbound calls they're going to be getting for the communities that potentially, didn't realize that, hey, look, could we be a target for an organic garage? And now we said, absolutely, you are. So I think it's a very exciting time. I know Savills is really excited to hit the ground running on this. And I know from, incrementally the leads that we've already passed along to them from, during COVID time to now them going out and now being able to formally speak with everybody. It's exciting that they'll be able to be, our representatives in ensuring that we're evaluating sites that fit our financial criteria. And you are absolutely right, is grow based off the real estate availability. And, we touched on the financial kind of structure before, but I just want to reiterate is that, between, landlord inducements, financing of equipment, because grocery stores are very equipment heavy, which is excellent for third-party lenders. From a CapEx standpoint, it is very minimal in terms of what we need to be able to scale the business. Are we in a position to, if we got an enormous amount of sites that we want to take advantage of and accelerate our growth, are we in a position, we mentioned it before and people know that we have a shelf prospectus out there that's for the next 25 months. Yes, but it's only for us to be in a position if we felt there was a great opportunity to accelerate our growth. But with our existing cash on hand, our access to third-party lenders, the landlord inducements that we get access to because of the style tenant we are, we're able to fuel, the growth that we see in the short term ourselves, and not do anything that's going to be overly dilutive to an investor, unless an absolute, we could explode in terms of our growth cycle, which would be good for investors and shareholders.
Yeah. No,
So yeah.
Matt, you address probably, it's interesting. I find sometimes some of these like investors, there's this paranoia about, oh my God, there's going to be dilution or this or that. First of all, there's a couple things. One is, they see that you have this prospectus in place. Again, like you said, it's not going to be for 20, and this is good for 25 months. There's not going to be any offerings right here. Obviously, you haven't raised money at these levels, so likely you're not going to raise money at where the stock is right now. You have $2.5–3 million cash in the bank, so you don't need to do it. But the main thing I think which people need to understand is to open these locations is not going to cost. And we saw the total cost is about $1.5 million. It's not going to cost. You're not going to lay out $1.5 million in cash to open a location. You might, in theory, you could open a location for like almost no cash because you could probably get credit lines. I mean, you can get credit lines. Each store generates cash flow. You could support. It could service whatever debt is out. You have margins and you have big margins. You could support the debt. You have a strong balance sheet. So in theory, you could do the whole thing you could finance the whole thing.
Yeah, and I think people get the wrong impression. We'll say an average store costs 1.6 to 1.8 million, and they figure the day you sign the lease, you're at 1.8 million. Well, you're not. So first of all, it's a 6-month build out cycle. And if you were to divide it, it's fairly equally over the 6 months in terms of the money pull. So when you're talking about a pull on your cash flow, it's relatively minor. Add in the fact that you're right. Whether it's an equipment lender, a bank, whoever we choose to deal with to finance, the hard assets, and equipment and things like that, it frees up a tremendous amount of free cash flow to continue to build multiple sites at once. So, from an investor standpoint, it's very important they understand, when I say 1.6 to 1.8, that is not out of pocket the day we sign the lease. And remember, if you work backwards from there in terms of inventory and stuff, we're only loading the store literally 2 weeks before the store opens. So when you start to work backwards in terms of the physical cash out of pocket, it is very minimal during the build out cycle. And you're absolutely right, Jack, with the financing options that are out there that we can access with our free existing cash flow, with the fact that we continue to cash flow, it gives us tremendous flexibility to look at multiple sites at once without somebody trying to do the math and say, well, Matt, it's 1.8 million a store and you have even 3 million in cash, well, you can only build 2 stores. Well, no, that's not the case, because I'm not out that money and I'm not cutting a check for 1.8 million in day one of our build out cycle. Like, it doesn't work like that. And so I think, hopefully from an investor community, they understand some of these points, because some people, obviously put out the wrong information, and that's not the case at all.
Yeah, it's really, it's listen, Matt, I'm glad you're doing this live stream, because I think like right now in the microcap space, like in Canada, it seems like from the comments I've read, like people really believe, like, oh my God, like it's going to be dilution. They're going to raise, they're going to do a raise right here at 30 cents. There's going to be, it costs, $1 million. People are not. So 2 things which I think are very important for people to understand, which, and you kind of touched on it. It's really important in the retail business, when you're scaling retail, when you're going from, let's say 5 stores to 500 stores, whatever it is to have those systems in place, which, franchises have. Now, you grew up kind of like your initial work experience, business experience was in one of the premier franchises. So you've been like indoctrinated in the whole mentality of what it takes to go, grow massive thing. How important it is to have that discipline, these systems. Like, for example, you just said something interesting. Like, when you open before you go into a store, you know exactly what the build out is going to be, what everything. This is not like a business where somebody's starting from scratch. They gotta they don't know. You're not reinventing the wheel. You already know exact. It's like a Starbucks or McDonald's. They already have again, like we talk about the binders, everything in place. Here's how you do this, and that. This is where the lighting needs to be. This is where they have it all figured out. They don't need, they can hit the ground running and they're off to the races. At the same time, they know exactly how much, basically, exactly how much cash flow you can predict. This is a very predictable business. I mean, maybe Tuesday might be a little bit slower than, Friday, whatever, but it's very predictable. So you can model things out. This is why banks love it. This is why.
Yeah, again, we what I need them to do based on our financial model, and going back to the build out process. Yes, we know exactly in terms of the inputs that are needed. Even to the point. Sorry about that. Even to the point where we can pre-book equipment far in advance to keep ahead of our development cycle, because we know the exact equipment down to how many shelves, what is the trim, everything that goes into a store. We can prefabricate in advance to keep up with our growth. So it from a store build out standpoint, it is very simple in terms of the model we have now, and it is predicated very much on the things I learned firsthand in my previous experience with Subway in terms of the inputs that go into store locations. We have our designated suppliers. We know what we purchase from them. We know what we need from them, when we need it, how long does it take to get it. And even in today's strained supply chain, we're still able to project out in advance, because we don't have to necessarily wait for a store fixture design to know exactly the inputs and equipment that we need. So yeah, you're absolutely right. I can't stress it enough. The systems are there. And from a CapEx standpoint, once again, I just want to alleviate everybody's concern. A lot of people potentially come on programs, and they're not the founder or they're not the largest shareholder. I'm the largest single shareholder in the company, and I'm not in the business of doing anything that's going to be overly dilutive at levels that are not beneficial to shareholders. We're giving ourselves freedom and flexibility for our future growth plans. And that's a prudent thing to do given the opportunity that exists in today's market. And, today's announcement speaks to that, or the opportunity that's at hand, that I think should be very exciting for any shareholder or investor looking at our company.
Matt, I think, listen, the proof is for any investor who has any doubts about, okay, the proof is you have 2.5 million in cash in the bank. This is not like one of these micro cap stocks where, they're running on fumes. They're borrowing from Peter to pay Paul. They don't know, I mean, obviously you run a very tight ship. Otherwise, if you didn't run a tight ship, you wouldn't have 2.5 million in cash right now in the bank. So it's pretty obvious. So I mean,
yeah, and
is it? Go ahead.
No, I was just going to say, and it's very important for people who have followed our history to understand that the changes that we made during COVID in terms of the free cash flow that it opened up for our company, switching from a centralized to a decentralized distribution facility saved the company, $1 million plus on our P&L. So we are the leanest and it's meanest, but leanest we've ever been as a company in the history, in terms of nothing dragging on our P&L. We have the foundation in place now that we've exited out of that centralized distribution model and exited out of the cost, everything from the lease to the utilities to the labor and everything that we had, which were input costs with our centralized warehouse that we previously had, are all off our books now. And so from a free cash flow standpoint, from a cash in the bank standpoint, we're the healthiest we've ever been to be ready for this point. Which you're absolutely right, Jack, is a kind of a bellwether point in our company's history to say that we're primed for growth. We've seen the opportunity in the market. We've seen how important grocery retail is. And I'll stress it again, and we touched on this on a previous interview, the opportunity that exists in the specialty food space, the specialty grocery space, which we operate in, which is the only real segment of the industry outside of ethnic foods that are growing, very healthy levels, double digits, that is attractive from an acquisition standpoint, potentially, if that's a route that we want to go down the route in the future. But it has shown itself to be attractive. Now is the right time, and the right time in our company's history to take advantage of the opportunity that's ahead of us.
The market you're in it's like, I don't know, hundreds of billions of dollars for the space you're in. It's one of the hottest areas. So here's the question. Let's say Savills calls you up. They got a bunch of locations, and they say, "Hey, Matt, look, these things, we got these 50. You drill 4 of these locations. They're going to say, look, they're ready to do it, whatever deal you want. How fast can you open, let's say, the first, I don't know, would you do 2 at a time? Let's say, can you do 4 at a time? I mean, how many, with your existing resources, let's say, here's the question. Okay, here's the question. With the existing resources that you have, how many stores simultaneously do you feel comfortable opening without any raising of capital?
Yeah, it depends on occupancy cycle. But going back to my point, it takes 6 months to build a store. So from the moment you start, you get the keys in your hand to the moment it's open with your first customer buying a product, it's literally 6 months. So how those stores overlap in terms of their occupancy dates and things like that, it's dependent on, once again, the signing of the lease and when do we take occupancy and the landlord has done, whatever prep work or things that they have to do. In terms of a construction team, our contractors and stuff, they're able to handle as many sites as we need to give them. I mean, these are companies that build for the largest grocery chains in Canada. So there's no concern in terms of a trade availability standpoint in terms of physically building the stores. And going back to an internal resource standpoint, once again, a 6-month horizon gives us more than enough time to not, and I touched on this before, look, we could build out the resources internally to sustain 30 stores while we're still 4 and have it weigh on our P&L. I'm not interested in doing that. What I'm interested in doing is adding incrementally to our management team, predicated on the store growth cycle, so that we're doing stuff fiscally prudently. And so a 6-month horizon from the moment we take possession to the moment we open gives us more than enough time to add any of the incremental support stuff that we need to help manage stores. So, from a construction standpoint, they can handle as many stores as we want to give them. From an internal resource standpoint, all our senior staff is in place, but we're adding a support staff, and we add that support staff in combination of the store opening cycles. And from a cash flow standpoint, it just depends on how the stores overlap in terms of what resources we'll actually need.
But what's the number? Yeah. What's the number, Matt? How many stores do you feel? Let's say you had these 3 or 4 great leases. Do you feel comfortable signing 4 of them, for this Friday?
This Friday? Yeah, I would say, Jack, yes. I mean,
Monday, I don't know.
without
Think about it
understanding
over the
the
weekend.
financial details and everything, the multitude of variables in it, all I can say is from a construction standpoint, from an internal resource standpoint, and from a free cash flow standpoint, we're in a great position to handle if multiple sites came at us all at once. Absolutely. I think what we're looking
Okay.
at is, over the next 12 to 18 to 24 months, what is out there in the market and how can we fill up, our development cycle to meet the opportunity that exists that we see very, very clearly.
Okay. But can we say that you'll have, let's say, can we get to, let's say, 10 stores, leases out, basically, leases out, construction, scheduled, getting to that 10 store number by, let's call it, August.
Yeah, I would never want to predicate a timeline. It's
Okay.
hard
Okay.
to say because
Okay.
there's so many variables. All I can say is it's in terms of, what opportunity is out there. And now that we've made it
Okay.
very formal, I think things will kind of
Okay.
crystallize very quickly in
Okay.
terms of that development cycle.
Okay. You don't want to be painted into a corner, is what you're saying. Okay. I get
I'm
no, no.
politely saying that. I do not want
Right.
to be
Right.
painted into, especially because these are things, as much as there's certain things in our control, there's things out of our control, and
Right.
the availability of real estate comes at different times. You could have tenants
Okay.
exiting out of sites where a landlord says, hey, look, I got a tenant whose lease is coming up in 6 months, but I want to put you in. There's sites that a landlord has to prep in advance before we occupy. There's multiple kind of variables that are outside of our control. What we're saying as a company is we're ready. So let's start seeing the sites. We now have representatives that will be handling the inquiries, that know our criteria. And so from that standpoint, yeah, I mean, it's very exciting in terms of what opportunities are out there. And now that we're formally saying, yes, let's see them, let's get them submitted, things could happen very rapidly.
Okay. So the bottom line is, okay, so the news is out. We're going to see, like, what kind of deals, what kind of deals the landlords are actually coming back with, because you're going to be getting offers. You're going to be getting stuff. So we're gonna know in the next couple of weeks, right? We're gonna know, like, what's, how desperate these guys are, what kind of inducements they're going to give you. But realistically, I think, Matt, I appreciate that you don't want to, like, you don't want to, like, say something which, you don't want to make, like, any crazy projections. But I would, and again, you're obviously you run a very tight ship, operation. But I would think that you have enough right now. I'm gonna, like, that you could do 4 stores, in the next 6 months easily without raising any capital.
Yeah, like I said, without looking at the all the economics in terms of, each site presents its own unique variables, financial variables. But going back to the point, do I think there's a lot of availability out there? Yes. And I think it's something, once again, we're not in a position to handle all that ourselves, which is why we want to work with great companies, and Savills is a great company who can handle those inquiries and vet them, and negotiate on our behalf. Do I think there's that potential out there? Yes. Do I think we have the financial resources, internally and externally, to access, to take advantage of, 3 to 5 sites if they were to come up? Absolutely, yes.
That's
Do
the
we have
answer
the
I wanted, Matt. That's it. That's the
Yeah,
answer. That's okay. Because
yeah,
this is this is the
I think we
takeaway.
do, because
Okay.
they don't all happen exactly at the
Right.
same time. It's not like they'll all be opening on the same
It's going
day.
to be
We'll
over the
take occupancy on
next.
the same
Yeah.
day.
It's going to be over the next 3 to 6. Yeah.
but
It's going to.
but things stagger themselves out. So do I think we have those sorts of resources to access if that's how many sites that came to our plate? Yes, I do. And like I said, going back to the cash pool, when you're looking at a 6-month build out, we are not writing a check for $1.5 million and then waiting 6 months for the store to open. Remember, when we have terms and conditions with our existing tradespeople, it is a slow burn on cash over a 6-month cycle. You're talking a couple $100,000 a month, depending on certain cycles. And when you're looking at alternative lenders and the things that we'll be accessing, the pull on our own internal cash flow is relatively minimal. So I'm excited to see formally what's out there. I'm excited for Savills to feel confident to go out to the market and know that they're representing us formally. And I think it's an exciting time, given the opportunities that I know firsthand, and that I also believe firsthand that are out there in the market for us to grow the business.
Yeah. So bottom line is I think the key takeaway today for people to the number one I think takeaway from the message for today is you have right now, without raising any capital, there's enough resources right now, financial resources and everything else, management, organizational, operational, to open, let's call it 3 to 4 stores this in 2020. Let's say 2020. Let's say six to 9 months, whatever it is. Real, so that's the thing, which basically means the company is essentially going to be doubling its size by the end. In other words, you're going to come out of next year at a minimum. At a minimum of double the size? Would you feel comfortable saying that at least? 2022. It's a year. 12 months is enough.
I believe that opportunity is there.
Okay,
once again,
okay. No,
it's a lot of variables, Jack, but
yeah.
A lot of moving parts.
That's without dilution. That's without capital. Okay.
But the opportunity is there, and I think investors should know with today's press release that we are, we're aggressively out there looking. So yeah.
So what that would mean is, let's say, essentially this is a company that's on the threshold of doubling. You don't have to say, I'll say, basically, Organic Garage is on the threshold of doubling in the next, let's call it 6 to 9 months. And again, the market is forward looking. So the market is going to be valuing the stock based on that double, probably in about 6 months. So essentially the market is going to be projecting a doubling to, let's call it 60 million revenues. Let's say you get a 3x multiple, 3x sales. That's a private market multiple. It's not a crazy multiple. So that's $180 million valuation, which is 9 times where you are now. So basically this is right here built in. It's like right there is your 10 bagger plus in the stock for anybody. Okay, so let's go on to the next topic, which is, but the big idea is you're not going to be stopping at 4 stores or 25 stores. Again, we talked about before in the previous videos, Organic Garage is a brand with global potential. I mean, with the margins, it's like the perfect thing, which can it can scale globally through multiple paths. It could be through whether it's internal growth or it could be licensing. You could license the name to, I don't know, you could license the brand to, I don't know, Germany, Italy, whatever, the UK, Canada, not Canada, you're in Canada, Mexico, whatever it is, right? You can, Japan, you can license the brand, the whole, not just the brand, but the whole systems. It's like a franchise.
Yeah, it's a great brand. Look,
to an operator, the whole thing.
It's a great brand.
You might open 100 stores. The potential is unlimited. Now let's go into the next thing. Based on, okay, so you're developing also your own proprietary brands. These, should I say vegan? What would you say? Vegan brand? What are they? The future of cheese. Is that a vegan thing? Plant-based.
I mean, Future Cheese is a plant-based brand. Yes.
Okay.
So we acquired that company earlier this year, and for anybody following the markets and kind of whether consumer trends or in the stock market, plant-based is on fire. And we just saw a great opportunity with a fabulous product with a second to none management team, which was an opportunity we just couldn't give up. And so, very excited. First products are out in the market. The Future of Butter, salted and unsalted SKUs hit stores. Had a great initial response from retailers, sold out of our first batch within 48 hours. And now we're focused on, the next tranche of stores and scaling up, and working on our next SKUs, which, we'll be launching. So, from a revenue source in terms of a subsidiary, it's great to have them on board. It only fuels our growth internally. And from a public market standpoint, it brings great eyes on the story because plant-based is very exciting and it is not going away. It is a huge shift in consumer taste that we're looking to capitalize on. So from that side of the business, we can speak about the organic garage growth story, but the future cheese growth story is, the upside is tremendous.
Yeah, I get this. I get the sense that I'm excited about the retail stores, but investors want to hear about the plant-based, the
Plant-based,
brands.
yeah. Yeah.
Because apparently in Canada, you guys, a bunch of these plant-based stocks have gone crazy, and of course, the U.S. we have, I don't know whether it's like Oatly or Beyond Meat. The whole kind of sector
Beyond
is
Meat. Yep.
very, very,
Yep.
very attractive sector. And so here's what's interesting. You know, Unlike many companies kind of in the space, you're coming at it from a unique perspective because you and your team know from operating these stores exactly what sells in retail. You know exactly what it takes for a product to move off the shelf, right? So you have the future of cheese. Now, how many SKUs are they going to have? They started with cheese. There's going to be a line of cheese. It's not going to be just one type, right? Because you got the super cheese guy, right? The Mr. Cheese
Yep,
expert.
yep. We have Mr. Cheese himself, Afram Pristine. But yes, the company has multiple SKUs. They launched the first two, the salted and unsalted plant-based butter. We have a brie that will be coming out. They have a cream cheese in multiple flavors they formulated. And then there's other SKUs that are, top secret that we're excited, that we'll make future announcements about. So yes, it is a full brand, a full line of SKUs that, in terms of the two co-founders, Afram Pristine and Craig Hardy, you can ask for better co-founders in a business, not only from their own knowledge. Afram Pristine, for those who watch the Food Network, had a very successful program on where he traveled the world talking about cheese. He is the foremost cheese expert, I would say, in Canada, if not North America, and is turned to by many media companies, television shows, to give his opinion and expertise on. Craig Harding is an executive chef, owns and operates very successful restaurants as corporate chef to companies like BMW. And so from an execution standpoint, from knowing what's on trend, what are eaters looking for, and most importantly, how do the products execute, Craig is the go-to guy. And so for the two of them, that two-headed beast, you couldn't ask for better. And so in our expertise, we lend them the direction of what is happening at the ground level. What are consumers talking about? And more so, because we're a retailer and because people are always pitching us to carry products, we're seeing products before they've even hit the shelves. So I know what's going on in the plant-based food space.
More than anybody, really more than anybody out there, I
Absolutely.
would say.
Absolutely. So, the ability for us to lend that expertise, combined with their experience and expertise, is a great situation for a new product coming to market. You can ask for kind of a better situation. And from a shareholder standpoint, adding a brand like this in a market that is just on fire, gives the stock side of the business, the public side of the business, a lot of ammunition, and room for growth. So that's
Matt,
what's really exciting.
you know what? Okay, so what we're gonna have to do, and we're running really late. So what I want to do is I want to have you come back like next week, and we're gonna spend like the whole episode just on your plant-based brands, kitchen
Yeah.
originals, future of cheese, because that's where a lot of investor interest is. We see there's a whole bunch of comments. People have a bunch of
Yeah.
questions. We're not going to have time to get to the audience question today, unfortunately. But I want to next week we're going to go through all of that because here the big idea is this: is that okay? It is with the brand, with Future of Cheese, with Kitchen Originals. These are brands that you could scale very quickly. It's not like the retail stores. Look, retail stores, you can't really go to 100 stores, by next month. It might take you a few years to get to 100 stores. Whereas when you have a brand, a hot brand, I mean, you can go to $1 billion in 18 months. I mean, we've seen that with I'm trying to think with some of the brands I've seen, these food brands like what's that, Chobani, the yogurt, or there's a whole bunch of them. I go
Look,
down the list. There's a bunch of these
CPG brands, yes, you have a
CPG.
much higher accelerated growth plan, and look, plant-based gives certain opportunities that non-plant-based brands don't necessarily have in terms of transportation, and things like that. So the future of cheese has global capabilities. Here in North America, Europe, and with Afram and Craig's kind of leadership and direction, you have two media personalities that can tell the story, better than anybody. And so it will be great, Jack. I look forward to talking more about it. Afram and Craig are eager to get on with you as well, and and answer your question. So absolutely.
Next week we're going to do a full thing, and we'll have them bring out the product. We'll have a whole, and I know a lot of people are interested in that. One thing I want to kind of wrap up with this idea is that essentially once you have, again, and I love the retail store, so I'm going to go back to the retail stores for a second. Because once you have a bunch of these retail stores and you have the brands, that's a really powerful combination, because then you have like this kind of growth flywheel. Because if you have 20 locations in a key area and you have your own products that you're putting out there with your own brands and everything else, you're able to promote the products properly, and that helps them gain traction at other retailers and everything else. And then it all feeds. It's a positive feedback loop.
Well, Jack, there's no better example. I think today, actually, we just launched a raffle giveaway on our social media for the Future of Cheese products. And I think we have 10 or 15,000 people on our Instagram alone, combined with Facebook. It's probably north of 25, 30,000 followers. And it's just a great example of how we accelerate the brand. And we're able to do those things and leverage our own following to help the brands that we own and operate. So it's perfect that you say that, because it literally, I think it just launched today, the raffle giveaway. And this is how we intend to give the brand a boost. It is a separate subsidiary, and as much as it is ours, and we're actively involved in its growth, we do want to give it its independence, because it is sold in stores outside of Organic Garage. I know we get a lot of people that ask us, hey, is it only sold at Organic Garage? No, we will sell it to anybody. It has its own separate management team that is geared towards growing the brand. But does it mean as a retailer that we can do things for the people that follow us and are in our stores? Absolutely. And so we will do those things because it's our brand. So absolutely.
Okay, Matt. Okay, so we're going to come back next week. We're going to focus a whole episode on Future of Cheese, and also Kitchen Originals.
I know, I got some of the products here for you.
Okay, perfect. And the whole idea of scaling everything else. I know we're going to have a lot of interest in that. Again, we're going to there's a ton of questions. People want to talk about that. So yeah, I apologize. I just got excited. I think the retail thing is by itself is like $1 billion thing right there. And it's a sure thing. It's right there.
Jack, I think, just to end off, I think you say it best. Look, the retail side, we have shown investors the ton of growth potential with today's announcement. This is not pie in the sky. We aren't a startup. We've been around for 15 years. We're doing 25 to 30 million in sales. We're not a startup. So we're geared towards growth. And then on the Future of Cheese side, which we'll touch on, and I know there's a lot of interest, and you're right, I've seen the questions popping up. There is just a ton of growth potential. So when you're looking and evaluating us, I think the two avenues that we have to continue to fuel interest and growth are definitely there. And I think, hopefully anybody looking at us is as excited as I am, because I think it's a great time for both sides of the business and for where we've positioned ourselves.
Okay, fantastic. Matt, on that note, thank you. And I'll catch up with you next week.
Absolutely. Thanks a lot.
Okay, thank you.